Welcome to part 2 of our video series on residential property management. In this part, we're going to talk about the tax benefits from having residential rental properties. The tax codes are very favorable for residential rentals, and I'm going to describe to you what you can expect as far as depreciation and tax write-offs that'll add to your bottom line and maximize your cash flow. Before I start, though, I want to make sure that you know that we are not CPAs nor tax attorneys. The example that I'm going through is just a hypothetical example, a prototypical home that uses all the tax code laws that are available to the best of our knowledge, and we ask that you seek professional advice from your tax advisor before you enter into any investment activities so that you fully understand how the specific tax codes may apply to you and your specific situations. Okay, let's start. Now, I'm going to take a sample property, a prototypical rental home, and let's say we've got a $300,000 home. Out of that $300,000 home, $25,000 is the value of the land, and $275,000 is the value of the structure. And that's a pretty typical land to structure proportion. Out of this sample, let's call it property A. Let's also say that we get $1,500 a month in rent for that property. And that's a pretty typical single-family home rental scenario. Okay, now let's take a look at what the taxes are. As a residential homeowner, and most of you are probably aware, for the home that you live in, you can deduct your mortgage interest and your property taxes right on your Schedule A under your itemized deductions. When that house, though, becomes a rental property, those deductions and a whole lot more will actually show up on Schedule E, which is gains and losses from residential rental properties. This is explained in Pub 527 from the IRS, and it's a very simple form, so let's go through it together and take a look. Schedule E looks like this. You've got in your columns A, B, C, D, those are all of your rental homes. In your rows, you've got your rental income, you've got your expenses, and at the very bottom of the form, you've got depreciation. Okay, let's drop our sample property in there, and let's see what it looks like. For your rental income, $1,500 a month times 12, that's $18,000 for property A. That's the annual income we're going to get from rents. Now, on the expense side, your mortgage interest payment and property taxes are going to slide right over to Schedule A and become the first two lines for expenses. But you know what? You're running your own little business. You're a landlord, you're hiring a management company to help you out, and every cost associated with that business now is deductible. Your insurance now is deductible. Your association fees are deductible if you have any. Any property management fees that you have, those are also deductible. Why try and manage a rental property yourself when you can hire a great management company and write off all the fees from the management company? Other expenses like repairs, improvements, upgrades, all deductible expenses. You can even have deductions for ancillary expenses like subscriptions to the real estate magazines or the newspapers, so you can stay abreast of the real estate market as an investor. Cell phone use, internet use, to the extent you stay connected to your property management company. Again, those potentially can be deductible. Even a home office expense that you exclusively use for your residential real estate business can potentially be deductible right on Schedule E. The nice thing is also travel is a potential deduction. We have owners that literally live all over the world. They can fly back to the city where their rental property is located and drive by their rental property, and of course they can deduct the entire trip as a business expense coming back to visit that business asset. So as you can see, you have quite a long list of potential tax deductions that will maximize your return and minimize your tax impact. Okay, where are we now on Schedule E? Let's say we've got $18,000 in income from the rent. On the expense side, let's assume a typical list of expenses. The mortgage interest for a $300,000 house might be $10,000. Your insurance might be $700-800 a year. Your property taxes might be a couple $1,000s. Add up all your other expenses, and let's just call it break even at the bottom of Schedule E before depreciation. So now we've got $18,000 in income, $18,000 in expenses, we're break even. At the bottom of Schedule E, the last thing that you're supposed to deduct is depreciation. Just like any business asset, a car, truck, plane, or a computer, a rental home has a depreciable, depletable lifespan, and Pub 527 from the IRS defines that as 27.5 years. What does that mean? Take your $275,000 value of the home, less the land, because you can't depreciate the land, divide by 27.5, and what do you get? you get a $10,000 depreciation expense that you can take for the next 30 years, or 27 and a half years to be exact, right at the bottom of your Schedule E. So now when you add up all of your rents, your expenses, and the depreciation deduction at the bottom of Schedule E, guess what? Now you're not break even anymore. Now you have a loss. It's not a real loss, but it's a depreciation-driven loss, and that non-cash accounting loss, as long as you're an active investor, will actually carry over to line 17 of your 1040. Guess what? You've just reduced your taxable income by $10,000. If you're in the 40% combined state and federal income tax bracket, you just saved yourself $4,000 in taxes. Divide that by 12 months, and you can see that each month you're saving approximately $330 per month in taxes. Bingo. Guess what? That's the primary benefit of a rental property. You can take your rental income and receive tax benefits of a few $100s per month. Now you are going to be cash positive right out of the gate, depending on your basis, of course, and your other expenses. This good news is that now the asset is pulling its own weight. What does that mean for you? It means you can move on with your life. It means that now you've got an asset that's covering its own costs, it's pulling its own weight, and your home is going to be able to move forward as a cash flow investment property rather than sitting vacant and being a boat anchor for you. Since your costs are covered, you can move to another home that's better for you and your family, or in a better location. You won't have to worry about selling your home in a down market, and I think you'll find that the tax benefits may encourage you to even consider keeping the asset for a longer period of time. The tax benefits are so great. As is the potential, of course, for the excellent returns as the market appreciates over the longer term. Okay, so that's the primary benefit, depreciation. Now, let's talk about selling a home. There are some things you need to be aware of if you sell a home that's converted to a rental property. Let's talk about that for a bit. Pub 523 from the IRS covers selling a residential home and rental property. When you sell a home, any home, whether it's a residential home or a rental property, you are going to owe capital gains, and most people are aware of that. There is something, though, in Pub 523 that will help you if you're selling a principal residence, and that's called the principal residency exclusion. What's that? Any home that you've lived in for 2 years out of the last 5 is a primary residence in the eyes of the IRS, and it qualifies you for a principal residency exclusion. What does it mean? It means that you can deduct your capital gains. You can limit the tax impact for capital gains. In fact, for individuals, the first $250,000 in capital gains will be tax-free if you're single, and $500,000 if you're married. That's a great deduction. And most people are aware of that. You can do that every 2 years, and it's called the principal residency exclusion. And again, that's from Pub 523 from the IRS. So what happens when you sell a rental property? Well, you can rent your home for up to 3 years, and if you sell your house before 3 years, you can still qualify for that principal residency exclusion described in Pub 523. So that would be something to consider once you convert your home into a rental property. While you may not have a significant capital gain after 3 years, it's still something to think about and keep in your back pocket down the road in case the market does pop up over the 3-year period and you do decide to try and sell your home and in fact would have capital gains. That's where you would want to invoke this particular strategy. When you sell a rental home, you're also going to owe something else in addition to capital gains. That's called a recapture tax on accumulated depreciation. It sounds kind of complicated, but it's really not. All it is the IRS saying, hey, we gave you a little depreciation benefit when the home was a rental, now we want some of it back when you sell the home. In our example, let's take a look at it and see what it is. Let's say we have property A, and we sell the house in 10 years. What do we owe on a rental property in terms of our tax obligations? Well, we're going to owe 2 things. We're going to owe capital gains, and we're going to owe that recapture tax on accumulated depreciation. Let's take a look at our example. Every year for 10 years, and let's just say we sell the home in 10 years, every year for 10 years, we're going to have taken a $10,000 depreciation expense at the bottom of our Schedule E for a net at 10 years of $100,000 in accumulated depreciation when we sell our house at year 10. Every year for 10 years, we've saved $4,000 in taxes from the depreciation benefit that we've written off. So we've saved a net of $40,000 in taxes. When we sell that home, we owe 2 things. We owe capital gains and we owe a 25% recapture tax on that accumulated depreciation. So we owe 25% of that $100,000, or we owe $25,000 in recapture tax when we sell. Ouch, that kind of hurts a little bit. Is it still a good benefit though? Well, the answer is yes, because you've saved what? You've saved $40,000, that $4,000 benefit each year going forward. So we've saved a net of $40,000. When we sell, we're only paying back $25,000, so you're still net ahead. And also, you're getting that $4,000 every year up front in tax benefits when you can use it for other investment activities. You're only paying the $25,000 in then-year dollars at year 10 when you sell, and that can even be out of the proceeds from the sale as the home is appreciated. So from a net present value of cash flow, you're still way better off. The big issue, though, is what's that capital gain number going to be, and what can you do to minimize the impact of that capital gain? There are some strategies that people have used over the years to successfully minimize their tax gain impact when they sell their rental properties. Over the years, according to the National Association of Realtors, typically residential real estate has doubled each 10 years or each decade over the last 80 years. Obviously, in the 5-year period from 2007 through about 2012, the market has completely fallen off a cliff. But in the next 10, 20, 30, 40 years, the expectation is that real estate will go back to more normal long-term appreciation rates. So, what does that mean for you? That means if you hold on to a rental home for 10 or 20 years, you could have your asset doubled. For example, let's say the value of our sample home is $300,000 now. In 10 years, the market could be worth $600,000. And another 10 years after that, it could be $1.2 million after 20 years. It seems a bit of a stretch when you think about it, but all you have to do is look backwards 20 or 30 years and the value of residential real estate then, and then you'll see it's not so hard to recognize that yes, the long-term appreciation rates of real estate can and will come back, and you will have some substantial capital gains. The big question then is, how do you minimize that capital gain impact? Well, there are a couple of strategies that investors have used successfully over the years. One of them is simply reestablishing principal residency, going right back to that Pub 523 exclusion. Let's say you want to retire and you've picked up a few rental properties over the years, and maybe you live in a different state. One strategy before selling any of your rental properties would be simply to reestablish residency just before you sell a rental property. How do you do that? You simply move back into your rental home. You can live in it as a summer home for 6 months and 3 days. That's a typical state statute period of time for each of 2 summers to reestablish primary residency. And guess what? Now it's your primary residence again. When you sell it, you now qualify for that Pub 523 exclusion for a principal residency. And you can exclude the first $500,000 in capital gains if you're married, or $250,000 if you're single. And by the way, that's the current number. That's likely going to increase with inflation as we move forward as well. So in 10 or 20 years, that could be $1 million or $1.5 million deduction, depending on what Congress does. So that is one great strategy, which is reestablishing principal residency just before selling, that will allow you to move forward and sell with a minimal capital gain impact. Another common strategy is the 1031 exchange. We have a lot of investors that say, hey, I like that strategy of moving back in, but guess what? When I retire to Florida, I am not coming back. I'm going to stay there. I'm not going to move back into my rental home. I just want to minimize my capital gains. I don't want to pay the recapture tax. I just want to have my cake and eat it too. Is there a strategy in the tax laws for me? Well, the answer actually is yes. It's been around for a long time. It's called a 1031 Tax Deferred Exchange. A 1031 Tax Deferred Exchange is sort of like an IRA rollover. Of course, it refers to IRS Code 1031, and basically what you're doing is you're selling one investment property, you're buying another investment property that might be a little bit more expensive, and as long as you follow all the rules for a 1031 exchange, you can roll all the capital gains and all the accumulated depreciation from property A into property B, and you don't pay any taxes. They're deferred. What are the rules? The rules for a 1031 exchange are pretty simple. You have 45 days from selling property A to identify property B. You've got 180 days from selling A to actually buy property B, and you have to use what's called a third-party intermediary company or a Starker company to do the transaction. They're really nothing more than a hybrid title company that also does IRS reporting. They'll perform both transactions. they'll send a letter to the IRS and they'll inform them of the new adjusted basis and depreciation, and guess what? You pay no tax. It's deferred. What can you buy? Just about anything. You can buy vacant land, residential rental homes, you can buy commercial investment property, farmland, multiplexes, duplexes, commercial strip malls. There's a lot of opportunity out there in the real estate world, and it's all at your fingertips with a 1031 exchange, and it's really quite unlimited what you can buy in terms of investment real estate. It doesn't have to be in the same state either. So you can move and mix and match properties in different states, and you can leverage the tax laws to your benefit for the states that you wish to do business in and you wish to occasionally visit. So it can be anywhere in the country. As far as the scale and the quality of investments that you can buy, again, very unlimited. You can build equity in any kind of investment property, and all those resources will be at your fingertips as you move into real estate on a larger and larger scale. You can also convert, for instance, from a single-family residential rental home maybe into a 2-unit commercial strip mall. Maybe that's your first strategy after having a residential rental home for a few years, is you move out and buy a commercial strip mall as your next opportunity. Certainly you do a 1031 exchange, you can roll all the capital gains and all the accumulated depreciation into that 2-unit commercial strip mall, and maybe you can put your business on one side or you can rent out the other to a Subway or a Chipotle and get a long-term lease. Great strategy. Lots of small businesses, lots of families own those types of properties. They're very lucrative and they can provide a great return down the road. And once again, you're rolling all of that tax benefit into the subsequent property and not paying any capital gains or any accumulated depreciation recapture tax. Keep that investment working for you as you go forward, and that's what's going to maximize your investment. The last very common investment strategy that I'll talk about is not selling at all. That's a great strategy, sort of like the Warren Buffett approach to real estate. We have a lot of people that say, when I sell, when I sell. In fact, we deal with a multitude of investors, tax attorneys, and CPAs daily, and most of them say, if I sell, because you can get some very significant tax benefits if you never sell your property. Let's look at it. Let's say you never sell your rental home or any 1031 exchange property that you've gotten yourself into. First of all, what do you own? You own a real asset. Real assets keep pace with inflation, and so do the rents for real assets. So if you do nothing but hold on to your residential rental property and never sell it, some interesting things happen. Number one is, guess what? Your rents are going to go up with inflation. Again, this is an inflation-protected asset, and so are the rents. So your rents are going to go up with inflation, your loan is eventually going to be paid down, and if you do nothing, you're going to be able to live off of that inflation-protected income for the rest of your life. You're going to have the same buying power because of the work of inflation with that real asset. But guess what? It's better than that, because what else can you do? You can also depreciate the home straight line over that full 27.5 years, and you're going to get that $4,000 tax benefit every year for the next almost 30 years. Because the home is going to appreciate over the long term, you're also going to have appreciation that's going to go and work in your direction. So as you can see, if you never sell the home, what do you never have to do? You never have to pay capital gains, you never have to pay the recapture tax, you have rents that go up with inflation, you can pay down your loan, you can live off of that income for the rest of your life, and the home is going to appreciate over the long term. When you pass on, the home value goes into your estate, and as long as the estate value is less than the estate cap tax maximum, the entire thing is going to go to your heirs tax-free. They can inherit it with a stepped-up basis, and they can do the exact same thing you did. They can take out an immediate loan for a couple $100,000 to use in their lifetime. They can rent it out. Rents go up with inflation. The loan gets paid down over time. For their investment, eventually they're going to have all income and no debt in their retirement, and they can live off of that inflation-protected income for the rest of their life. They can redepreciate the home straight line over 27.5 years, and if they never sell, they can pass that on to the next generation, and so on and so on. So you can see, from an estate planning point of view, real estate can be a great fit for many people. Talk to your CPA or tax advisor about this and many more tax benefits of owning residential rental properties. I think now you can see that there are some really great tax benefits and strategies with real estate investing, and I hope the information we've provided helps you get started on the right foot.